If I handed you one single dollar and I told you that tiny little bill could eventually turn into a house, a retirement fund, or a complete financial freedom, most people would laugh at the idea because, humans are terrible at understanding slow growth at the beginning. And the scary part is that almost everyone just waits too long to start investing because they think they need thousands and thousands of dollars and the perfect timing of, come on, or some secret Wall Street knowledge. And when the truth is, most powerful force in investing is something so simple that people ignore it every single day. It's the snowball effect. Imagine standing at the top of a snowy mountain with a tiny snowball in your hand at first. It barely looks like anything. It's small, it's weak, and honestly kind of pathetic. Well, like, you're no. But the second you push it downhill, it starts collecting more snow, and then more snow sticks to that snow. Then the ball gets heavier, faster, larger, until eventually it becomes an unstoppable force crashing through everything in its path. And that's exactly how investing works, except instead of snow, your money collects returns, dividends, interest, and growth over time. And the craziest part is that the beginning feels painfully slow, okay? Which is why most people quit before the magic even happens. And let me tell you, it's magic. No. And let's say someone invests $100 a month starting at the age of 20. Not a fortune, and that's basically a few fast food runs and a couple subscription people forgot to cancel 3 years ago. And if they average about 10% annual returns in the stock market and continue consistently by retirement, they could have over $500,000. Now, here's where things get wild, though. Someone else who waits just 10 years to just start investing may need to invest two or three times more money every month just to catch up. Time matters more than intensity, and the snowball rewards patience more than speed. That's why people who begin early often beat people who earn more money but start late. Investing is one of the only games where getting started badly is still better than waiting for perfection. Most beginners think investing is about picking the next giant company before everyone else does. But historically, consistent investing, almost every single time, it beats emotional investing. Okay. The average investor usually underperforms the market because they panic when things go down and get greedy when things go up. And they buy high because everyone is excited, then sell low because everyone is terrified. Meanwhile, the quiet investor who keeps buying every month regardless of the headlines slowly builds the wealth while everybody else is busy stressing and refreshing their phone, and like the stock market owes them emotional support. The real power of the snowball effect comes from compound growth. The compounding means your money earns extra or earns returns. Then those returns start earning their own returns. It's basically money hiring, tiny employees that never sleep. If you invest $1,000 and it grows by 10%, you now have $1,100. The next year, you're not earning returns on 1,000 anymore. You're earning returns on 1,100, and then 1,200, and then 1,500, and then 20,000, and eventually the growth becomes so powerful that your investment starts making more money than your actual job. That's when things start feeling unfair in the best way possible. Warren Buffett became one of the richest investors in history, but what most people don't realize is that the majority of his wealth came later in because compounding accelerates massively over time. And the first years are tiny, and the last years become explosive. It's like planting a tree, and for years it looks unimpressive, and then suddenly it becomes huge and provides shade for generations. And most people dig up the tree after 6 months because they expect instant results. Social media has destroyed patience. Everyone wants overnight success, overnight abs, overnight business, overnight fame, and overnight wealth. And by investing almost boring when done correctly, it's repetitive, it's steady, it's disciplined, and honestly not very flashy. And that's why it works. The market rewards consistency more than excitement. And one of the biggest mistakes beginners make is trying to time the market. People sit around waiting for the perfect moment to invest while their cash slowly loses value from inflation. Inflation is like a silent thief that steals purchasing power every single year. $100 today will not buy the same amount of stuff 10 or 20 years from now. That means if your money just sits in a basic account doing nothing, you're actually moving backwards over time. Investing allows your money to potentially outgrow inflation and build real wealth. The funny thing is that many people are terrified of investing because markets sometimes crash. But historically, stock markets have recovered from recession, wars, inflation spikes, and banking crises and global panic over and over again. Every major downturn in history felt terrifying while it happened. Yet long-term investors who stayed patience were often rewarded. Think about it this way. If you owned a business that made strong profits, would you panic before because somebody temporarily, lowered the price they were willing to pay for it? Probably not. Yet people freak out when stock prices drop, even though, lower prices often mean investments are on sale. Experienced investors understand that volatility is normal. Fear is temporary. Long term growth is what matters. Another huge part of snowball effect is automatic investing. Automation removes the emotion. If money automatically gets invested every paycheck, you stop relying on motivation. Motivation disappears faster than fries at a family gathering. And I'm a potato on another channel, so that's offending. Its systems beat feelings. Even small amounts invested consistently can become massive over time because consistency it creates some momentum, and people underestimate what 10 years of discipline can actually accomplish because they focus too much on short-term results. The market doesn't usually reward impatience; it rewards endurance. Dividends also play a massive role in the investing snowball. Some companies pay shareholders a portion of profits regularly when those dividends get reinvested. They buy more shares, which then produces even more dividends later. It becomes a cycle that keeps feeding itself. Reinvested dividends have historically accounted for a huge percentage of total stock market returns. It's basically your investment cloning themselves little by little, and the earlier you start, the more powerful that cycle becomes. One reason why wealthy people often keep getting wealthier is because they own assets, and assets are things that can grow in value or generate income stocks, real estate, or businesses and investments. They work for you even when you're asleep, and most people spend their lives trading time for money. But investors, they slowly build systems where money starts generating more money independently, and that shift changes everything. Instead of every dollar depending entirely on your labor, your investments become financial workers operating 24 hours a day. And the crazy thing is that many millionaires are not super flashy people driving gold covered rocket ships while eating lobster in a hot tub. Many are ordinary people who invested consistently for decades and avoided massive debt and stayed patient. Boring habits build extraordinary outcomes. Another mistake people make is assuming they missed their chance because they didn't start young. Starting early is powerful, okay, but starting now is still indefinitely better than never starting at all. Too many people spend years regarding the past instead of building the future. The snowball only works when you actually push it down the hill. Waiting another 5 years because you feel behind only makes this problem worse. Even investing small amounts to teaches valuable habits like discipline, long-term thinking, risk management, and delayed gratification. Those habits often spill into every other area of your life. And here's another important truth nobody talks about enough. Wealth building is not always exciting. Some years, your investments may barely move, and some years, markets may crash hard. Some years, the news will scream that the economy is ending for the 18th time that month. But the long term investing, it requires emotional control. The market transfers money from impatient people to patient people over time, and the investors who usually win are not necessarily the smartest. They are often the ones who refuse to quit during difficult periods. Fear destroys more wealth than market crash themselves because people panic and lock in loss permanently. Patience allows recovery to happen. Diversification is also critical. Putting all your money into one random investment because somebody online promised insane returns is how people end up learning financial lessons the painful way. Spreading investments across broad index funds, industries, and or assets helps reduce risk while still allowing long-term growth actually. Index funds, they become incredibly popular because they all allow people to invest in large groups of companies rather than, betting everything on one single stock historically. Broad market investing has outperformed many active traders over long periods. The beautiful thing about the investing snowball is that eventually momentum takes over. And at first, your contributions matter most. Later, growth matters more. And then eventually, your investment it gains. It can exceed what you personally contribute, and that's when compounding starts feeling almost unbelievable. Imagine planting a seed for years and suddenly waking up inside a forest you built yourself. That's the long-term effect of consistent investing. Financial freedom rarely happens in one dramatic moment, though. It usually happens quietly through years of discipline nobody applauds at that time. Or the biggest investment secret about investing is that time is the multiplier most people they waste. Every year delayed makes the hill steeper. Every year invested gives the snowball more power. Nobody can guarantee short term market performance, but history has repeated and shown that disciplined long term investing has been one of the greatest wealth building tools ever created. The hardest part is not understanding the math. The hardest part is mastering your emotion long enough to let the process work. Because the snowball effect is not about getting rich tomorrow. It's about building unstoppable momentum that grows larger and stronger with every passing year until one day people look at your results and think, "Hey, you got lucky," when really you just started rolling that snowball long before they did. Thanks for watching today's video. If you found value in today's video, please subscribe. YouTube says I need it to grow, so please subscribe. I'd highly appreciate it. Also, check out this video to the right. It can help you on your financial journey. And also, comment down below. I would love to hear from you. I respond to all positive comments, and I would love to hear from you. Have a good day. We'll see you guys tomorrow. By the way, taking the weekend off from now on. I've been making videos 7 days a week for 3 months now, and I'm going to be taking the weekend off. From now on, we're just going to be doing 5 days a week, 5 videos a week, and going to be taking a little bit easier than what I was doing. So far, I've been doing 6 YouTube channels, I think now, and I need to ease up on the gas a little. Have a good day, guys. See you soon.